Blackrock, one of the most influential institutions around the world, but their business model is being challenged. Their returns cannot keep up with the pace of the S&P 500. Their iShares ETFs are losing ground, and Blackrock ETF fees have been going lower and lower. Fortunately, there seems to be a solution for BlackRock's trouble. It's ambitious, but behind the scenes preparations have started taking place. It is a solution that requires heavy changes to BlackRock's business model. It requires giving up power now to get more power in the long run. And it requires merging into a different company with a similar name. The pinnacle of haute finance. The kings of private equity. Blackstone. BlackRock and Blackstone share more than just a similar name and a special relationship with conspiracy theories. BlackRock, the world's largest asset manager, has its roots in Blackstone, the largest alternative investment manager. First, it seemed like BlackRock is building the bigger empire among the two, but recently it seems like there's trouble ahead. In 1988, Larry Fink, then a bond trader at First Boston, co-founded BlackRock as a part of Blackstone. Stephen Schwarzman, co-founder of Blackstone, provided Fink with $5 million in seed capital to start the company.
You decided to get into other businesses?
The first one ended up as Blackrock with Larry Fink, and Larry brought people over, and they were called Blackstone Financial.
Blackstone Financial. And so you actually owned the firm or owned part of the firm?
50-50.
50-50, okay. So you own 50-50, and now Blackstone Financial is now Blackrock, which is managing like $6 trillion, I guess, or something like that.
6.5.
$6.5 trillion, okay. So how did they escape from Blackstone?
Well, they didn't really escape. We set up an economic arrangement which ended up being inappropriate for a business that was growing as rapidly, needed to add as many people. And I made a mistake. I took the original agreement. I didn't want to change it, which was advantageous, for my side. The BlackRock people, Blackstone Financial people were frustrated with that, and that was the judgment of an amateur, me.
In other words, someone was a bit too greedy during the wrong times. Greed can be good, but it's a mechanism you should use in the right place at the right time. And as a rule of thumb, if you are just getting started in your career, it's almost always the wrong place and the wrong time. This separation enabled BlackRock to diversify its services and client base, ultimately leading it to become the world's largest asset manager. But here's the deal. Today, Larry Fink's company manages around $10 trillion, while Steve Schwarzman's Blackstone manages just around 10% of that, so around $1 trillion. But both likely generated similar profit last year. BlackRock's annual net income for 2023 was around $5.5 billion, while Blackstone's should be somewhere close to that. At least in 2021, they did $5.9 billion. You would think that with so much more AUM, so assets under management, BlackRock would be able to generate much more profits than Blackstone, but that's obviously not the case, because the business models are so vastly different. In the past, BlackRock was fine with this. Their business was growing rapidly year after year, so why change course? Also, lots of assets under management gives you lots of power. Note to young ambitious chads, in business it's not always about the bottom line. Two businesses might earn exactly the same amount and have exactly the same growth expectations, yet one gives you much more influence and power. Case in point, media business. It all seemed good. Countless young ambitious megalomaniacs around the world were assured BlackRock is the shit. But recently the core business model of BlackRock has started slowing down, and not just a bit. It's so significant that BlackRock is seriously worried about its future. BlackRock has thrived on the popularity of exchange-traded funds, or ETFs, over the past 2 decades, driven by passive investment strategies. Private investors realized at some point that it's pretty dumb to give money to fund managers who also have no clue how to generate above-market returns. So they started dumping money into ETFs. many of which were BlackRock ETFs. By the end of 2023, $3.5 trillion of BlackRock's assets were in its ETF business. But there's speculation that passive investing has peaked, and that's not BlackRock's only problem. If we look at this chart, we see that both BlackRock and Blackstone can't keep up pace with the S&P 500 lately. Another challenge is the declining market share of BlackRock's iShares, which once dominated the ETF market, has been losing ground to competitors like Vanguard and State Street. Vanguard, for example, has been capturing a larger share of new ETF inflows, while iShares' growth has slowed. That's a bit of a catastrophe if that's one of your biggest businesses. But that's not all. Additionally, the fees on BlackRock's ETFs have been drastically decreasing. In an effort to attract and retain investors, BlackRock has slashed its fees. The average expense ratio for BlackRock's ETFs has fallen from 0.25% a decade ago, and that was already considered cheap, to around 0.12% today. Now, if you're a private investor like me, you're like, yeah, that's awesome. But if you're BlackRock, which I assume you're not, this puts significant pressure on your profit margins. Lower fees mean less revenue per asset under management, which impacts the company's overall financial health, especially when coupled with the other challenges it faces. So what's the solution? Is BlackRock going down? Turns out Larry Fink already has a game plan. In January 2024, BlackRock made a big announcement.
We do have some breaking news, and it's breaking literally right now. BlackRock making the biggest changes to the firm in more than a decade. It's acquiring global infrastructure partners in a cash and stock deal valued at about $12.5 billion. In a memo, Larry Fink saying that the infrastructure deal and infrastructure itself is one of the fastest growing areas of our industry over the next 10 years.
Any big deal, there's got to be an imperative behind it. So Larry, let me start with you, from BlackRock's point of view. Why do you need this deal? You already are in infrastructure. You've got a pretty substantial operation there. You identify as an opportunity, but why do you need GIP to get done what you want to get done?
Well, thank you, David. It's great to be here today. No, we believe infrastructure is only at the beginning of a real major asset class. And our business is a business of people. Right. And if you don't have that cultural connection, that friendship, that
continuity, it makes it harder to do.
Okay, let me cut through the BS for you. GIP is one of the largest independent equity and debt fund managers focused on infrastructure. They have more than 100 billion in client assets targeted toward energy, transport, water and waste, and so on. This deal puts BlackRock closer to where the action is: private equity and private credit. And not in any market, but in infrastructure. It's currently a $1 trillion market, and it's forecasted to be one of the fastest growing segments of private markets in the years ahead. Now, does this mean that BlackRock is about to fundamentally change its business model? Will it turn more into a Blackstone-like private equity monster in the future? Or will it keep making money mostly with boring but sticky management fees? Nobody knows. There's just one thing that's certain. This brother is now liquid.